the revision to the jobs report was about payroll employment. It had no effect on our estimates of the unemployment rate. It was the case last year where those revisions to employments are relevant, that the unemployment rate was rising. So I'd say that the revisions paint a more consistent picture of the labor market, right? The unemployment rate had risen enough to trigger the Sahm rule. And we now know that the payrolls, they'd slowed. And in fact, they'd slowed even more than what we had thought at the time. So it kind of more in harmony together, I guess.
With the dynamics of where we are, particularly with immigration, is a 4.3% unemployment rate what used to be a higher unemployment rate? Can you say that?
So the unemployment rate that we would kind of settle into when things are good, it does move around over time. I think one reason we see unemployment rates that are quite a bit lower than, say, decades ago, 4.3% historically is quite low, is that we have an older workforce. Workers who have more experience tend to, move in and out of jobs, lose jobs less frequently. So I think a lot of it's demographics where we're at kind of this lower unemployment rate. And that's why when you're trying to think about where are we headed to a recession? Are things really going south? You look at changes in the unemployment rate as opposed to a particular level. Like that's such an important, and we've seen in recent months, the unemployment rate nudging its way up, still slowly, but moving in the wrong direction.
Behold the shifting balance of risks, and I want to ask you about that and the Federal Reserve's capacity to deal with it. And I look at the most recent Bloomberg survey of Wall Street economists. There's this expectation here that the language is going to change from the Fed chairman when he speaks on Wednesday about the labor market and the condition that it's in. What is your sense of this Federal Reserve's capacity to deal with the shift here more toward the labor markets? It seems it's going to be the case. And as Tom and I were mentioning just a moment ago, we're at a point here where we really don't have a full grasp on the personnel around that table on Tuesday and Wednesday. That's still very much up in the air. Perhaps a basic question, but does that color the conversation that's going to take place there on Tuesday and Wednesday at all?
The conversation and the rate decision is going to hinge on the data. And the Fed they are grappling with a really tricky environment in that inflation's too high. Like it is not, and it's not moving towards the Fed's target right now. And then you have employment that has really softened. I mean, it might be structural, it might be immigration, but it might not be. It might be demand is really slipping. And so like the Fed's got one tool and they've got two problems that are going in different directions. So they're going to have to frame up and really like assess from the data which of these two risks is bigger and more persistent. I mean, that's the way the Fed has outlined that it approaches this. That's how they're going to do it next week. But I mean, the reality is this is not going to be a normal FOMC meeting, right? There's a lot, and frankly, it may matter more for the inflation outlook, the rate outlook, not just next week, but going forward, who actually is sitting at that table and voting. Because it will be a big change in Fed policy if Lisa Cook is not there.
Claudia Sahm with us, folks, as we have an eventful Friday. We're awaiting an FBI briefing here in the 9 o'clock hour. David Gurr and Tom Keene with you nationwide. Claudia, one of the magical things you had was a tour duty with Matt Shapiro at Michigan. He, folks, did more on inflation research than anyone I can imagine within academics. I've been talking a lot, Claudia, in my stilted way, about the substitution effect. Is it in place now with this new bout of inflation? Lisa, help me here. Joe Weisenthal had beef prices up, banana prices up,
coffee
prices through the moon. Claudia, is it normal Sahm economics now as we substitute and try to get to Monday with our diminished purchasing power?
Right. So, I mean, it's a basic reality of economic behavior. I mean, people are going to react to prices. That's why we have prices. It tells us something about what's scarce and what's available. And so there absolutely should be seeing some adjustments, but we have to be, real about the extent to which people can make substitutions. Right? Like there are, housing is a very expensive for many Americans, and it's also a necessity. Right. So there is a process of adjustment going on. Some of our inflation statistics capture that substitution in real time better than others. But I think we also shouldn't Like, I would also push back on some of the discussions around tariffs where it says, oh, it's a relative price change. Like, the tariffed goods, their prices go up. So then people just shift to something, shift away from that. And then inflation overall doesn't go up. I don't think that's the read that we get out of the data. Inflation is stalled out and is moving ever so slightly higher. So I think substitution is there, but there are limits to how much people can deal with these price changes.